Right now, as we look at the live market action, Beyond Meat Inc. is trading at exactly $1.29, down by approximately 3.73% on the day. The stock has shed 5 cents from its previous close, and the chart you are seeing reflects a company that is currently hovering dangerously close to the psychological and technical precipice of the $1 mark. While the broader market might be discussing tech rallies or sector rotations, the story here is far more specific and, frankly, far more brutal. We are witnessing a valuation reset that many argued was inevitable, yet the speed at which it is unfolding today catches even the most bearish observers off guard. When you see a stock like Beyond Meat trading at $1.29, the immediate expectation, especially if you have been following the headlines from October, is that this is a dip or a discount following that massive speculative surge we saw just weeks ago. The narrative floating around retail forums and social media comments is that the plant-based giant is oversold, that the recent crash is market manipulation, and that a bounce back to $3 or $4 is just around the corner. That is the expectation, that this is volatility play waiting to snap back. The reality, however, is substantially colder and more grounded in solvency mechanics than market sentiment. What we are seeing today is not just a red day, it is a repricing of survival risk. The drop to $1.29 is not a technical pullback, it is a direct response to the fundamental deterioration confirmed in the November earnings report and the realization that the liquidity runway is shrinking faster than the company can cut costs. The expectation is a trade. The reality is a distress signal. To understand why this specific price point of $1.29 matters so much, we have to look at the last 48 hours of trading volume and institutional positioning. The stock is currently failing to hold the $1.30 support level, a zone that algorithmic traders have been defending for the past week. The fact that we have sliced through it today suggests that the bid liquidity, the buy orders waiting to catch the falling knife, has evaporated. We are seeing a volume profile that is skewing heavily toward distribution. This means that larger holders, likely institutions or longer-term funds that stuck around hoping for a turnaround, are finally capitulating. They are not selling because they want to, they are selling because their risk models no longer allow them to hold a stock trading near penny stock territory with a balance sheet this leverage-heavy. This creates a feedback loop. As the price drops, more risk triggers are hit, forcing more selling, which drives the price down further. This downward pressure is compounded by the lingering hangover from October. If you recall, just last month, we saw a massive, unexplained rally where the stock surged over 300% in a matter of days. That move lured in a significant number of retail investors who bought in at $2, $3, or even higher, believing the squeeze was back. Today, those investors are sitting on losses ranging from 50 to 80%. The overhead supply, the number of shares held by people waiting to sell the moment the price ticks up, is enormous. This creates a ceiling on any potential rally. Every time the stock tries to move up to $1.35 or $1.40, these trapped buyers sell to get out at a smaller loss, shoving the price right back down. This is why the $1.29 level feels so heavy. It is being crushed by the weight of millions of shares bought during the October hype cycle that are now underwater. Let's shift gears to the fundamental engine driving this decline, because the stock price is just the symptom. The disease is visible in the third quarter financial results released back on November 10th. The company reported a net loss of over $110 million for the quarter. To put that in perspective, that is a loss rate that, if annualized, threatens to wipe out a significant chunk of their remaining cash reserves. But the headline number isn't even the worst part. The most alarming detail was the $77 million non-cash impairment charge. In plain English, an impairment charge is management admitting that the assets they have on their books, factories, equipment, inventory, are worth far less than they previously claimed. It is a confession of destroyed value. When a company writes down assets of that magnitude, they are effectively telling you that their past investments have failed to generate the projected returns. This charge was largely linked to the suspension of operations in China, a market that was once touted as the future growth engine for the company. The exit from China is a massive blow to the growth story. Without the international expansion narrative, Beyond Meat is forced to rely on the domestic U.S. market, which is currently shrinking. The revenue figures confirm this shrinkage. Net revenues fell over 13% year over year to just above $70 million. You have to ask yourself, how does a growth company in a supposedly booming sector see double-digit revenue declines? The answer lies in the consumer shift. We are no longer in 2019. The novelty of the plant-based burger has worn off, and the flexitarian consumer, the meat eater who occasionally swaps in a veggie burger, has largely abandoned the category due to inflation. When grocery bills are at all-time highs, paying a premium for a plant-based patty that costs more than real ground beef is a luxury fewer people can afford. Furthermore, the health halo has slipped. There is a growing counter-narrative focusing on the ultra-processed nature of these meat alternatives. Consumers are reading ingredient labels more closely, and seeing a long list of stabilizers and isolates is deterring the health-conscious demographic that was the brand's core base. This double whammy of economic pressure and health skepticism is crushing demand at the exact moment the company needs volume to cover its fixed costs. Comment below with your thoughts on the consumer shift. Do you think the ultra-processed label is fair, or is it just bad PR from the meat industry? I want to hear if you have stopped buying these products and why. Now, we must address the elephant in the room, the short sellers. This is critical for anyone holding the stock or thinking about buying this dip. Short interest currently stands at roughly 93 million shares. This is an astronomical figure relative to the float. It implies a massive portion of the available shares have been borrowed and sold by traders betting the stock will go lower, likely to zero. However, before you get excited about a short squeeze, look at the days to cover metric. It is currently sitting at around 0.71. This is a very low number. It means that because the daily trading volume is so high, short sellers can cover their positions in less than a day if they need to. A squeeze usually happens when days to cover is high, like 10 or 20 days, meaning shorts are trapped in a burning building with a tiny exit door. Here, the exit door is wide open. Shorts can enter and exit at will. This suggests that the short interest isn't trapped, it is comfortable. They are aggressively selling every pop, and they are not afraid of a squeeze because the liquidity allows them to escape if things turn against them. Furthermore, looking at the borrow fee rates from major brokerages, while they have spiked occasionally, they are not at the crisis levels we see in true squeeze candidates. This indicates that there are still shares available to borrow. The smart money is betting that the company will face a liquidity crisis before it can turn a profit. They are looking at the $1.1 billion in debt and the shrinking cash pile, and they are doing the math. The bond market, which is often smarter than the stock market, has been pricing Beyond Meat's debt at distressed levels for months. When bonds trade at such deep discounts, it means creditors are worried they won't get their principal back. Equity holders are last in line. If the bondholders are nervous, the stockholders should be terrified. We also need to discuss the role of retail sentiment in this specific price action. You might see threads on Reddit or X claiming that the company is a takeover target. This is a common coping mechanism for investors in distressed stocks. The logic goes, the brand is famous, surely Nestle or Tyson will buy them. But let's look at the reality of M&A in 2025. Major food conglomerates are cutting their own portfolios, shedding underperforming brands. Why would they buy a company with falling revenue, massive losses, and a billion-dollar debt load? If they wanted the technology, they could likely wait for a restructuring event and buy the assets for pennies on the dollar rather than paying a premium for the equity now. The buyout savior expectation is dangerous because it encourages holding a losing position based on hope rather than fundamentals. The reality is that strategic acquirers hate negative margins. They buy cash flow, or at least a clear path to it. Beyond Meat right now offers neither. The chart also reveals a disturbing lack of reaction to good news. Recently, the company announced a new version of its sausage product and some expanded distribution in Europe. In a healthy bull market, the stock might have popped 10% on that news. Today, it barely flickered. When a stock ignores good news and sells off on bad news, it is a classic sign of a bear trend. It means that the market has stopped caring about incremental product updates and is solely focused on the existential risk, cash burn. The market is asking, will you exist in 2 years? Not, do you have a new flavor? Let's zoom in on the specific intraday dynamics we're seeing right now. The selling pressure is consistent. We aren't seeing panic dumping, vertical red lines, which would actually be a sign of capitulation and a potential